Today's lesson will be Chapter 7, Problem 2B. What we're going to be looking at today is the LIFO method of accounting for cost of merchandise sold using a cost card under the perpetual inventory system. And we're going to be doing the LIFO method, which means that the last units that we purchase are going to be the first units that you sell. It's completely opposite of the method that we did in the last video. The LIFO method does not match the physical flow of goods throughout the retail business, but it is a method that is used for income tax purposes. And as you're going to see, your cost of merchandise sold will result in eventually affecting your net income, and your net income will be lower with the FIFO method. And so for income tax purposes, you will pay less income tax. And so that's why management uses the LIFO method. And again, it doesn't really match the physical flow of goods, but it is an acceptable method, and a lot of companies do use it because you can save on your income taxes. You might remember from the last video where we talked about the FIFO method, I said that there was the LIFO method that companies could use. They can also use the weighted average method, but the LIFO method will yield to you the lowest amount of net income, and so therefore you'll pay less taxes on this net income. So let's look at some transactions that have happened for the Dune Company. And basically it's the same company that we were using in the last video. We're just looking at it from a different point of view from the LIFO method. So we're going to be doing this for a 3-month period, and we're going to start with April the 3rd. We had some inventory that was left over from the last month that's just brought forward. So we have some beginning inventory. So on our cost card, just like we did before, our cost card is set up exactly the same as it was for the FIFO method. We're going to start by entering in our date. Now in Cengage, they've already entered the date in for you, but you're going to have to fill in the white boxes here. And so we're going to start with our quantity that we have left over from last period on April the 2nd, which is considered to be our beginning inventory. And the number of units that we have is 25 left over from the last period. And what they cost us per unit was $1,200. And you might have noticed that if you take 25 and multiply it by 1,200, it will give you 30,000. So they were nice to you and gave you the total cost, but sometimes, you know, on test questions and things like that, they won't give you the total cost. You need to know that you multiply the quantity times the unit cost to get the total cost. So that's the cost of our inventory that we have to start with. Then on April the 8th, we made our first purchase for the month of April. And so we're going to move to our cost card, and we're going to record in the purchases column. And you can see they've got it set up for you in Cengage, where you just move to the next block, which happens to be in the purchases, the quantity. The quantity that you purchased was 75 units. So we'd put in 75 units here. And then you also want to put in the unit cost. Notice the unit cost of those units that you purchased are $1,240 a piece. And then you simply multiply your quantity times your unit cost to give you the total cost of that purchase, which is $93,000. And in the real world class, you would have source documents that would back up this purchase. You probably have a invoice in front of you is where you be getting the information to record on this cost card. Now, just like we did in the FIFO method, you're going to bring down your beginning inventory units, and you're going to record them as your first layer, because we have purchased a new layer of inventory that had a different cost associated with it. We're going to record it as a separate layer. So now, because of the April 8th transaction, we have two layers of inventory. One where we have 25 units at $1,200 a piece, and one where we have 75 units at $1,240 a piece. When we're doing the perpetual inventory system, you might recall that we're keeping up with our inventory on a continuous basis. So once we made this purchase, we had to add it to our inventory. So now we've got 100 units in ending inventory that we can draw from, but they have separate cost involved with them. So there are separate layers here. The next transaction is on April the 11th, and it's our first sale. Notice we sold 40 units. Also notice that this 2,000 here is not the cost of the units sold. You're going to find the cost of units sold in the cost card. This 2,000 is the marked up price. This is the selling price of those 40 units. It has nothing to do with the cost. It's what you've marked it up so that you'll make a profit as. So make sure you pick up 40 units that you're selling. Make sure you go to the cost of merchandise sold columns. And what we're going to do different in the LIFO method is the last units that you purchased, which were on April the 8th, are going to be the first units that you sell. So what we've really done is we've sold 40 out of the 75 unit purchase that was on April the 8th. So all 40 units are going to come from this last layer, which is 1240. Therefore, we get the name LIFO, last in or the first sold. This is the last units you have in inventory. So these are going to be the first that you're going to sell under the LIFO method. So then what I'm going to do is I'm going to put in my calculator 40 units that I've sold times the cost per unit, which is $1,240. And what that will give me is my cost of goods sold for the April 11th transaction of $49,600. You might recall from the last chapter, this amount was always given to you. You remember when you made a sale, they had the cost of merchandise sold written down. Well, in this chapter, you're finding the cost of merchandise sold. They don't necessarily give it to you. And the cost of merchandise sold is going to be based on which method you're using. In this case, we're using the LIFO method. So the last units in are the first that are sold. So what's happening here, pay attention right here, is we're going to pull down our 25 units. Got to keep these still in order by their layers. You still have 25 units at $1,200 a piece, which is 30,000. And now we've sold 40 of the 75 units. So we only have 35 units left at 1,200. excuse me, at 1240. Because I'm drawing from these units right here. I sold 40 of the 75, so I have 35 left at 1240. So then you have to multiply 35 units times 1240, and that will give you 43,400. And just like we did in the other problem, it's always a good idea to check your work. Just to make sure your math is correct, because if your math is wrong up here, it's going to follow all the way through. And so check your work off after each transaction. That's what I would suggest. The next transaction that we're going to be doing is the April 30th transaction. Again, we have a sale. This time we're selling 30 units. So in the cost of merchandise sold, I'm going to show that I've sold 30 units. These 30 units are coming from my last purchase, which was on April the 8th at $1,240 each. So we would multiply 30 times 1240, and that will give you a total cost of merchandise sold on April the 30th at $37,200. So then we're going to write down what we have left. We have all of our beginning inventory layer left, all 25 units at $1,200 a piece, which was 30,000. And because we sold 30 of the 35 units, we have 5 units left over at the cost of $1,240. So 5 times 1240 is 6,200. Check your work. And our math is correct. So we're going to move on to May the 8th. On May the 8th, we had another purchase. We purchased 60 more units at $1,260 a piece. Excuse me. So in your quantity, you're going to put down the amount, which was 60 units. And the cost of those units was $1,260. Notice our unit cost is increasing, so we're in a period of rising prices. Multiply 60 times 1260, and that will give you, and they've already done this for us, that will give you 75,600. Now here's a situation where we have left over our beginning inventory units that we got to bring down. You must bring these down in order. If you don't, you're going to get messed up. So our beginning inventory units were 25 units at $1,200. Oops. Make sure you're in the right column. Which is $30,000 worth of our beginning inventory we still have left over. We also had 5 units left previously at $1,240, which had a total cost of $6,200. Then we bought 60 more units at $1,260 this time for a total cost of $75,600. So in this problem, we now have 3 layers to draw from. We have 3 layers of ending inventory, consisting of your beginning inventory, your 5 units that were left of the April 8th purchase, and the May 8th purchase. I'm going to check my work. And obviously I put down something wrong there. So it caught me. I think I made the same mistake in the other problem. Well, your instructor is definitely human today. All right. So the next transaction happens on May the 10th. On May the 10th, we have a sale of 50 units. So on May the 10th, we're going to take all 50 units from our last purchase, which was on May the 8th. So 50 units would be taken from the 1,260 unit cost, and then we would multiply 50 times 1,260, and that will give us 63,000. And then we bring down our beginning inventory units. We haven't sold any of those. So because we haven't sold any beginning inventory units, we're really showing that our ending inventory is going to have a cost associated with it that's based on the earliest purchases. So it's not on the last purchases, it's on the earlier purchases, which, as you know, had a lower cost per unit associated with them. You're going to bring down the 5 units that were left over from the April 8th purchase at $1,240, which was $6,200. And then you sold 50 of the 60 units, so you only have 10 units left at $1,260. And 10 times 1,260 is 12,600. And I'm going to check my work just to make sure my math is okay. And we're okay in that transaction. So we still have 3 layers of inventory to draw from. Then on May the 19th, we had a sale of 20 units. All right. Notice that the last units that we purchased, which were the May 8th units, all of those are going to be sold because we sold 20 units. So we're liquidating the entire last layer. They've all been sold. And since we sold 20 units, we've accounted for 10. We're going to liquidate the entire layer that came from the April 8th purchase. So all 5 units at $1,240 are going to be liquidated. And now remember, you sold 20 units, you've accounted for 15, so the remaining 5 are going to come out of our beginning inventory. So 5 times 1,200 is 6,000 that came out of beginning inventory, $6,000 worth. And since we sold 5 of the 25, we have 20 left at 1,200. So you would multiply 20, 20 times 1,200. So you have 24,000 in your ending inventory as of May the 19th. So in this case, we liquidated 2 of the layers completely, and then the third layer, we had part of it left at 20 units left in ending inventory. And we're going to move on to May the 28th, and we had another purchase. So we got to put it in the purchases column here. And we purchased on May the 28th, 80 units at $1,260. And 80 times 1260, they gave you that amount, was 100,800. And now we have 2 layers. Bring down your 20 units that were left of your beginning inventory. Got to put these in the right order. And you swing across what you just purchased. And I think I forgot to check my work on the previous one. So everything looks good though. All right, so on June the 5th, we sold 40 units. All 40 units are going to come from the May 28th purchase. So we would multiply 40 times 1260. And that'll give you 50,400. Our beginning inventory, we still have 20 units left at $1,200 a piece for 24,000. And then we've sold 40 of the 80, so we have 40 remaining at 1260, which is 50,400. Check your work. And the next transaction is on June the 16th. On June the 16th, we sold 25 units. So 25 will be taken from the last purchase, which was on May 28th. 25 would be taken from the 40 units of the purchase that we've got here. The cost per unit is $1,260. You would multiply 25 times 1260, and that will give you 31,500. We'll bring down our beginning inventory units that we had left, which were 20 at 1260. Excuse me, 20 at 1200. That was 24,000 as a total cost. And then we're going to take out of the 40 that we had left over, we're going to take 25 away from that to see what we have remaining. We have 15 units remaining at 1260, which was from the May 28th purchase. And we're going to check our work. And we're ready to move on to the June 21st transaction, which is a purchase. We're purchasing 35 units at 1264. And 35 units times 1264 is 44,240. Now we're going to bring down the layers as we had them, bring them down in the order. Start with your beginning inventory layer that you had left over, 20 units at 1200 for a total cost of 24,000. You had 15 units left over at 1260. And that came from the May 28th purchase, which was 18,900. And then you just bought 35 more units at 1264. Oops. 1264 for 44,240. Check your work. Then on June 28th, we sold 44 units. So if we sold 44 units, we sold this entire layer. Remember, it's the last in or the first ones you're selling. So 35 at 1264, we've liquidated that entire layer. And I forgot how many units we sold. We sold 44 units. We sold 44 units. We've accounted for 35 of those units. So we're going to back out 35 units. And that's going to leave us with 9 units that we've sold. Let me check my work on that again. Keep forgetting how many units I sold. We sold 44 units. And we've accounted for 35 units. So I'm going to back 35 away from this. And that leaves you with 9. So we have 9 units at 1260. And that's going to come from these 15 units here. So we took 9 units out of these 15 at 1260. So 9 times 1260 is 11,340. And then we had all of these beginning inventory, the 20 units left in beginning inventory at 1,200, 24,000. And then we sold 9 of the 35. Excuse me, that's not right, because we liquidated this 35. We sold 9 of the 15 units. So we'll have 6 units left at 1,260. And 6 times 1,260 is 7,560. And I would check my work, and your math is correct. And so this is your cost card. And the last thing that we need to do is we need to add up all of our cost of merchandise sold to determine what would go on the income statement. So we're going to start with 49,600. We're going to add to that 37,200. We're going to add to that 63,000. And then we're going to add 12,600. And then we're going to add 6,200. And then we're going to add 6,000. And then we're going to add 50,400. And then we're going to add 31,500. And we're going to add 44,240. And then we're going to add 11,340. If I've added all those correctly, the amount is 312,080. All right. And then your ending inventory just comes from the last June 28th transaction. So you'd add 24,000. 24,000 plus 7,560. And that gives you 31,560. All right, so once you found your total cost of merchandise sold, you can see that was the total of this column right here that we completed. The total cost of merchandise sold would go on the income statement. It's the largest expense, so it goes right underneath sales. And we would subtract the cost of merchandise sold from our sales to get our gross profit. What we have left over here in ending inventory for our merchandise inventory, that's an asset account. And this will go on the current asset section of the balance sheet. Now in part 2, they want you to determine the total sales. so that you can subtract the cost of merchandise sold from the sales to get the gross profit. To get the total sales, we have to go back up to our information that was given in our problem. Oops. And we're going to have to combine all of our sales together. So we'll start with the sale that was on April the 11th. Remember, we said that the 2,000 was the selling price, and we had 40 that we sold. So 80,000 is the total amount of sales from April the 11th. Then we're going to add to it our sale from April the 30th, which was 60,000. Then we're going to add to it our sale on May 10th, which was 100,000. Then we're going to add to it our May 19th sale, which was for 40,000. Then we're going to add to it our sale on June the 5th, which was 90,000. And then we're going to add to it our sale on June 16th, which was 56,250. Then we're going to add to it our last sale, which was 99,000. And if I've added all those right, it gives me total sales of 525,250. Let me check to make sure my math was right on that, because there would be no need to go any further if it weren't, and it's okay. So the next thing I need to do is subtract from my total sales. This should say less total cost of merchandise sold. The total cost of merchandise sold for this 3-month period is $312,080. You're going to subtract that from the total sales. So 312,080 would be subtracted from the total sales figure. And that's going to leave us with the gross profit that we have to cover our operating expenses of $213,170. And then in part 3, they ask you to determine the ending inventory. Well, you've already done that. You just pick up the amount that was for these two combined, 31,560. And that's all they ask for. And so that's all you do with the LIFO method. Notice in the LIFO method, what you need to remember is the last units in are the first units sold. So it does not go with the physical flow of goods, because normally we would sell whatever we bought first. But this is just a way that management can put a cost on their cost of goods sold. Now, I'm not saying that companies that use the LIFO method to value their inventory also use the LIFO method for their physical flow of units. That's not true. They would still use the first in, first out method for that. But just we're putting a cost or a dollar amount on our cost of merchandise sold. And we can use the LIFO method or the FIFO method or the weighted average method, which we'll talk about the next time. So under the FIFO method, which is what we did the last time, we took the first units in that we purchased and sold them first, which does match the physical flow of goods. But with the LIFO method, the actual units we sold does not match the physical, does not match the LIFO method. We still use, we're still going to sell the units that we got in first. It's just that the LIFO method is a way to place a dollar amount on the cost of goods sold, and it is acceptable to do this. And management has a choice. They can use the FIFO method or the LIFO method. And the main differences is that with the LIFO method, your cost of merchandise can be larger than it would with the FIFO method when there are periods of rising prices. So your net income or your gross profit, as they've shown you in your problems, will be less with the LIFO method than it is with the FIFO method, because the cost of goods sold will be more with the LIFO method. It makes the net income less. And even though we want to show as much net income as we can, we also want to take advantage of tax savings. And so we pay income taxes on our profit for proprietorship and partnership types of business. So the less money we show on our income statement, the more tax savings that we're going to generate. So the FIFO method will yield a higher amount of net income. Thus, you'll pay higher taxes with the FIFO method. And that's about all I want you to get out of this for today. So I'm going to stop sharing this with you, and we'll see you again next time. Bye-bye.